black swan, as we all know now. And that's, by the time the black swan happens, it'll be too late for you to own gold. You have to buy it now as a safety precaution, and then just be patient.
Hi, and welcome to Wealthion. My name is James Connor, and today my guest is Pierre Lassonde. Pierre was the co-founder of Franco-Nevada, the world's largest precious metals royalty company, and also past president of Newmont Mining and the former chair of the World Gold Council. So there is no one else who can provide a better perspective on precious metals and how they can be used to benefit your portfolio during times of economic uncertainty. Pierre, thank you very much for joining us today.
It's always a pleasure. Thank you for having me.
Pierre, I want to focus this discussion on precious metals and more specifically gold and how it can be used to provide protection to your portfolio against the constant erosion of inflation. And when we want exposure to gold, we can use many different products, including buying physical gold or gold mining stocks or a gold royalty company. And given you co-founded the world's first precious metals royalty company, I want to start right here. What exactly is a royalty company?
A royalty company is very different than an operator. It's actually closer to the physical metal itself. So a pure royalty is a percentage of the top line of a producer. So if you have, let's say, a 4% royalty, you will get, and the producer produces like 100,000 ounces of gold a year, you get 4% of 100,000 ounces, which is 4,000 ounces of gold delivered to your account completely cost-free. So that is the particularity of a royalty. Now, there's another form of royalty called a stream royalty, where the royalty company gets a percentage of the production, whatever it is, on a yearly basis at a fixed cost, a cost that's fixed by contract when the streaming is created. So those are the two forms of royalties that we have today in the market.
So you made mention that a royalty company is totally different from an operating company and more like owning the physical gold, but there's many advantages to investing in a royalty company. Can you just review what these advantages are?
Well, the advantage number one is that a royalty company has no capital expenditure. So there's no the producer, the operator, cannot call on the royalty company to join in the CapEx. And when we know today that, to try to build anything, it's like $1 billion, $2 billion, up to, like you look at some of these numbers, they're absolutely enormous. So there's no demand in terms of capital. Second, there's no inflation because when you have a percentage of the top production, in the case of the pure royalty, you're not affected by inflation. In fact, you gain by it because, of course, the gold price keeps going up and you have no costs. So you're totally protected from inflation. And then finally, which is the best part of royalty, is the optionality that you get from owning this royalty and the land that it's attached to.
So I just want to examine some of those points in a little more detail. You made mention of the fact that once you buy a royalty, you do not have to put up any further capital for CapEx. And so if I want to provide an example, let's say if you have a royalty on a mine that produces 100,000 ounces a year, and they want to grow that to 200,000 or 300,000 ounces a year, that will take a lot of CapEx. And as a royalty company, you don't have to put up one additional penny for those additional ounces.
That is correct.
So that's a major benefit. And to your point, the CapEx are associated with building a mine now is many, many billions of dollars, and it can take many years also to get permitting. Does a royal company have to concern itself with permits?
No, I mean, the royalty, all you do is cash checks. So all you need is really good auditors to make sure that, you get the amount that you're paid. But, the royalty company does not have any say in the operations.
So you made mention of the fact that the number one or primary advantage is optionality. Can you expand on that and maybe provide an example?
Yeah, I say to people that if you can get free optionality, I can show you a way to become a millionaire very quickly. There are three forms of optionality in the mining business. There's price optionality, there's land optionality, and then the third one, I call it time optionality. So price optionality, it's very easy to understand in the sense that, if the gold price goes up from $1,800 to $2,000, well, you've been given a $200 lift, and the royalty holder gets all of it at no cost. So that's like a 10% boost in your revenue without, again, having any costs associated with it. So even if the operator has inflation and, the margin for the operator may end up being exactly the same, your margin has just gone up 10% because the gold price has gone up. So if you think that the gold price is going to 3,000, well, you're going to get the entire benefit of the move from today's price, 2,000 to 3,000, delivered to the royalty holder. So that's a huge advantage. The other one is land optionality. And that one, it's interesting. In our business, there's no analyst whatsoever who put any value attached to the land owned by the mining companies. And their reason is that, well, we don't know, how to calculate the land optionality. So you don't get any value for it. But yet, from a royalty standpoint, a royalty owner, once a company has spent, like, let's say $2 billion to put a mine into production, it's put up all the CapEx and it erected all the structures, and now you're doing whatever, like 20,000 tons a day or 50,000 tons a day. Well, the operator will do everything it can to keep on going. So when they start production, for example, they may have let's say 5 million ounces of reserve, but the first day you start mining, your reserve are going away. So what do the operator do? They explore. They keep exploring around the land to be able to keep mining. And all the exploration comes at no cost to the royalty holder. So you don't have to put up as a royalty holder any money for the exploration, and yet you get all the benefits in the world and then some. And of course, my favorite story is the Franco-Nevada story, how we got started. The first royalty that I ever bought was on a piece of land in the Carlin Trend of Nevada, which had, at that point in time, approximately 500,000 ounces of resource and about 300,000 ounces of reserve. And I paid $2 million for that royalty. It was a 4% royalty off the top. And there was also a 5% net profit interest royalty attached to it. And we're talking here 1987 and 1985. And the property was sold to a company called Barrick. Then the property at the time was producing about between 30 and 35,000 ounces of gold from a bunch of small open pits. And the property was sold to Barrick. Barrick comes in, start exploring. And lo and behold, they find a 50 million ounce gold deposit. And the production went up to 3 million ounces a year. So that royalty that I bought for $2 million has paid out over $1 billion since, and there's still probably another $500 million to come. And that's what I call land optionality. I mean, that is the ultimate. Okay, I don't want to give you the impression you do that every day. This is the best deal I've ever done, and unfortunately, it was my first deal. Okay, I don't think to be repeated quite the same, but we've done it at Franco-Nevada 3 times, where we bought asset for $2 million and turned them into, literally billions of dollars. So it does happen, and that's why I love land optionality. And when we buy a royalty, usually we get it for free because nobody knows how to calculate it, and it comes with the royalty. And then the other one is time. Time is always, once you own a royalty on a piece of land, it stays there forever. And so times may change, and the new technology may come in where all of a sudden the 10, 20 million ounce that you have, like 20 years ago you couldn't mine them, and then now they have new technology, and lo and behold, it can be mined, and time is on your side. So those are, to my mind, the really incredible aspect of royalty companies.
Pierre, that was a fascinating story. I just want to summarize the benefits of owning a royalty company. And first of all, there's diversification. You own a large number of assets. Second of all, you're not exposed to capital risk or an increase in costs at all. And then you have this optionality benefit. Are there any other advantages that we should be aware of?
No, you've got it about right. The fact that, as a royalty holder, you benefit from inflation because you have no cost or fixed cost if it's a stream royalty. And you have no exposure to capital costs, to exploration costs, but yet you get all the benefit of all of that.
And I want to get your views now on the price of gold. It's depending on what day of the week it is, it's around $2,000 an ounce. And some people aren't too happy with that performance, given the growth in the money supply over the last few years. A lot of people think it should be up a lot more. What are your thoughts?
Oh, I mean, I think that gold is at a new high. It just hit a new high like a couple of weeks ago, like $2,080. I think it's incredible. And I couldn't be happier with where gold is right now and its performance. But I think what the people are reflecting is the fact that the gold equities are at a 50% discount to where they should be relative to the gold price. And that is really inexplicable. I mean, I've been in the business for 40 some years, and I don't understand why there's such a disconnect between the gold equities and the current gold price. And when I think of the next year, 2 years, the gold price, it's like an insurance policy. I mean, your house doesn't go on fire every day, but you do buy the insurance policy in case it happens. And it's a bit the same thing with gold. We all know that, the U.S., for example, current budget deficit is going to be something like $1.8 trillion. And over the next 5 years, it's like $2 trillion a year. And they already have $34 trillion of debt. I mean, when I was a kid, those numbers were reserved for astronomy. Okay, they are so big, they're so huge, it's just unbelievable. And at some point, the US dollar will become suspect. But we all know it is suspect. But until you have a break, until something happens, you may see the dollar continue to drift sideways with its current valuation. But like it happened in 1971, like it happened in 19, I can't remember when they had to have the Plaza Accord. There is dislocation event that occurs, black swan, as we all know now. And that's, by the time the black swan happens, it'll be too late for you to own gold. You have to buy it now as a safety precaution, and then just be patient. You can't, think that, I'm going to buy it today and then it's all going to happen tomorrow. This is a slow moving train wreck. Okay. And it's happening, but you have to have a bit of patience. But $2,000 gold right now, it's really good.
You made mention of the fact that the gold producers are severely underperforming gold price. And do you think a lot of that has to do with wage inflation and also fuel prices?
I don't think so, James. I think that when you look at the producer, they've been able to contain costs by a long shot. I mean, the total cost to produce an ounce of gold is actually coming down. I mean, it peaked at around on average, it peaked at around, like $1,200, and now it's drifting back to 1,100. And cash costs are closer to $800 an ounce. And some producers are as low as 500 cash costs and all-in costs of like 700. And yet, they discount a gold price of like, $1,500 gold when it's over 2,000. So who's right? I mean, is the equities right where the gold price will come down to 1,500, or is the gold market right and the gold equities will, double from where they are today because of, they're like at 50% of their intrinsic value at $2,000 gold.
So as we mentioned on the onset, there's many different ways to invest in gold or to get gold exposure. And I'm curious to see how you invest. Do you prefer royalty companies or producers, or do you also invest in developers and explorcos?
Look, I have a vested interest in Franco-Nevada. So, of course, I invest in a royalty company. I think that the Franco-Nevada business model is the best business model in the world, bar none. I mean, the company, we have essentially 42 employees, and with revenue of over, like $1 billion a year, like on a revenue per employee, I think we're probably the best in the world. And, the business model, and we have over 100 royalties. Actually, it's over, I think it's 400, but operating, I think it's like around 100. So incredible diversification, as you point out. And then I have also intermediate size companies. And I have, some development company, but there, I will remind you, you probably are aware of the curve that I invented like about, 20, 30 years ago. It's called the Lassonde curve. And it shows the share price over time, what happens, for example, if you have a discovery. So let's say the share price is 5 cents, I'll go up to, let's say $20, and with all the hype and everything else, and then it comes back down to like 5. And then there's a long period where, once you've done the initial reserve, and then you have to have the feasibility study, and then you have to fund the construction. Today, that zone is becoming the killing fields because with the permitting process being so long, very few companies have the backbone, have the financing to last, like that 3, 4, 5 years. You take, for example, this morning, Barrick announced that they finally got the record of decision from the Nevada Bureau of Land Management for Gold Rush. Well, they've been waiting for, I think, 5 years. Okay, so a company like Barrick can sustain that, but any other company who doesn't have the cash can't do it. So those are becoming the killing fields where if you're shareholders, you probably going to get diluted down to nothing. And usually the best place to buy a stock in that range is once it's fully funded, fully permitted, and about to start construction. And hopefully you have confidence in management that they can build on cost and on time, okay? Because that's where the other big hiccups happen. So if you have a good management, it's fully, and usually at that point, you can buy a stock for 50% of its net asset value, and you can double your money if you're patient over like a 2-year period. And so those are sort of like the kind of things that goes through my mind when I, select stock for a portfolio.
Interesting points. And Pierre, in the past, you have said that junior mining companies are like fireflies. And I want you to expand on that and tell us what you mean by that statement.
Well, back in 1990, I wrote a book. I took 6 months, 9 months out of my life actually to write a book. And it was one paragraph on junior mining company. And I did a 10-year study at that time of junior mining companies. from 1980 to 1990, what happens to them? Okay, and I had about 3,000 companies. And don't forget, like the 80s were, rock and roll for the mining industry. Okay, it was the discovery of Hemlo. I mean, like, the Voisey's Bay discovery. I mean, there was like discoveries. There was like money pouring in, and the number of companies peaked at around 3,000 junior mining companies. And what I found out is that out of that, only 1% of these companies ever made it to production. And the other ones, they get reorganized, they get bankrupt, they kept alive by the promoter, just, they're walking dead, if you want, but they're kept alive. And all that promotion, like these drill holes that, yeah, they're good, but they don't amount to anything when you start to look at, where's the beef, okay? And that's why I call them fireflies. And unfortunately, that is the reality of our industry. And it's not Mother Nature has given the same odds to all businesses. And I don't want to disparage our business, because if you look at technology, same odds, okay? It's 1 in 1,000, 1 in 10,000. If you look at biotech, same odds. We're no different than any other sector in the world, but we just have to really, take that and put it in the back of our mind. When you're buying a junior mining company, an exploration company, you're rolling the dice like anybody else, okay? And you could go to Vegas and do just as well, okay? And, if you like the promoter and you like the place and you want to have fun, by all means, go ahead. But you have to understand, the odds are not in your favor.
You can have a lot more fun in Vegas too.
I think so, but hey, it's a lot easier to talk about the stock you own than, what you've done in Vegas.
Pierre, we can't have a discussion on gold without discussing Bitcoin, and quite often it's referred to as the new gold or digital gold. And Bitcoin is up over 120% on the year. What are your thoughts on Bitcoin? And do you think it's become the new gold and maybe it's taken away a lot of interest in gold?
Well, I will turn it back to you with a question. Are central banks buying Bitcoins, or are they buying gold? Well, the reality is that they're buying gold, okay? And central banks believe that gold is money. And that's why they're beefing up their reserve, whether it's China, Russia, all the central banks that are not attached to the dollar. They want gold reserve because it's the only money that the US can't get their hands on. They can have the gold bars in, Beijing or in Moscow or in, Turkey, and the US cannot have access to it. And given what's happened over the last few years and the very high-ended nature of the United States vis-a-vis other countries, central banks have figured out that, we need to diversify, and the way to do it is with gold. And so they have, put the stamp of approval. Gold is money. Bitcoin, it's a mathematical equation in space, okay? It's like it benefits a few people, mostly unsavory. It's not regulated. The day it's regulated, it'll probably, I wouldn't say it's going to die. There's a place for it, but it has no intrinsic value. It has, I guess, to me, I can't fathom why anyone would buy Bitcoin. It's a nice imagination, but long run, not sure where it's going to go.
And I guess the other big advantage to owning gold is you can hold it in your hand, whereas you can't hold Bitcoin.
And gold is universal. I mean, if you unplug your computer, how are you going to get access to your Bitcoin? Okay, if you're in Gaza right now, you need to get out, or you're in the Ukraine, you need to get out. Your computer was blown to pieces, electricity doesn't work. What do you have? Nothing. Gold, you got it in your hands, you can run with it. You can, buy things, okay? Like anybody will accept gold. It's a universal value. Go in the middle of Africa where you're Bitcoin, try to buy something. Well, you know what? Take a hike, okay? Gold, everybody everywhere knows what it's worth. Okay, the price is posted, it's international, it's global. It has, that aura that Bitcoin will never have.
Pierre, I want to get your thoughts on M&A now. We've seen a lot of M&A happening in the past few years with a lot of the large producers. Newmont, Barrick, and Agnico have all been very acquisitive. And Newmont recently closed on the Newcrest deal. But I want to get your thoughts on this and why are they being so acquisitive as opposed to growing their reserves through exploration?
Well, the answer is a bit of what I just said earlier. The fact that right now the entire sector is discounted by 50%. So it's becoming cheaper to buy the ounces on Bay Street or Wall Street than it is to put your own money to try to find the ounces. So when you can buy reserve ounces for less than $100 an ounce, and resource ounces for like $20 an ounce. You can't find stuff. You can't find gold for that price. So it's cheaper to go buy the companies, and cheaper to go, buy on Bay Street than try to find them. And that's what's happening, especially for good deposit. Anything over 5 million ounces is quite rare. And anything over like 15 million ounces of reserve is very rare. And the cost to find those are in the hundreds and hundreds of dollars. So if you can buy them for 100, like blessed, that's what you do. And I think these companies are acting very smartly in buying these companies.
And do you think there's an element, you mentioned how rare it is, but do you think that's also an element in that there's just no more large deposits to discover?
Oh, I think there's, plenty of large deposit yet to be discovered, but that's the key. It's like yet to, okay? Like, someone's got to spend the money and go find them. And, if you look at the record of discovery, the big mining companies usually find about half the deposit, and then the junior intermediate find the other half. But they have to be funded. And right now, the junior market is like, it's almost impossible to get money. So, again, the best thing is just to go and, buy them in the market. But no, I think you look at Canada. Canada has the second largest land mass in the world. Have we explored that, to the point where we can say there's no more? Not a chance. There's still enormous amount of places where we have not been, we have not explored. There will be, great discovery to come, but you need the patience and you need the money. And when a company is burning, like 5 million ounces a year, when I say burning, producing 5 million ounces a year, they have to replace 6 a year. 5 years, that's 30 million ounces. I mean, where do you get that kind of deposit? And sometimes it's just easier to buy someone who's already got one and assure yourself of the next 20 years to give yourself time to find that next big one.
Pierre, that's a good overview of gold. I want to move on now and discuss copper with you. You're a big believer in copper. Why?
It's very simple, James. There was a study done by Shell a number of years ago, and they pointed out that today, 80% of the terminal energy that we use is carbon-based. That is petroleum, oil, coal. And 20% is electricity. And if we want to get to a green world and limit carbon emission to, a certain amount, you have to flip that on its head, and you have to go to 80% terminal energy being electricity and only 20% being carbon-based. Well, when you look at, terminal energy 80%, that means you're going to need electricity. You're going to need, electricity distribution system, and it's all copper. I mean, if you look at your buildings, all the air conditioning, all the elevators, all the transportation, your car, it's all moving because of copper. So when you look at the copper demand over the next 20 years to get there, we essentially need to more than double the current production. And where are you going to come up with mines that produce 300,000 tons of copper a year to replace the depletion and double the production? So like this year, it's pretty good. We have a couple of really new sizable mines that are coming in production. Next year, maybe one. But then after that, there's a void. And you look at that and you say to yourself, like, we're going to have to, and the time to permit, I mean, you can find them, maybe, but then it's like 6, 7, 8 years to permit, and then you build them, it's another 3, 4 years. You're looking at like 10 to 12 years. So when I look at 2025 to 2030, I think that copper in particular is going to do very, very well. I'm quite optimistic about the entire copper industry.
So you provided a good framework on how investors can invest in gold and copper to benefit their portfolios. Now, let's tie that into the economy. In the last few weeks of 2023, the market was on a tear, the stock market, the bond market. Physical gold has caught a nice bid, and it's all predicated on the notion that the Fed has done lifting interest rates and they're going to start cutting. And depending on whose research you read, it could be as soon as Q1 or even Q2. What are your thoughts on the U.S. economy and as we head into 2024?
In terms of gold and copper, James, I don't think it matters what the U.S. economy is going to do or the rest of the world, because particularly copper next year, the balance is very, very tight. And I would say the same with gold. So it doesn't really matter. And as far as I'm concerned, I think inflation is going to be more enduring than the Fed would like. I don't see interest rate coming down very quickly. Same for the rest of the world. The Fed is going to be caught in, a catch-22 situation where interest rate on the American debt is going to be by next year more than the entire defense budget of the United States. And it's going to get worse over the next 5 years, like a lot worse. So the Fed, at some point in time, they're going to do like they did in Japan. And the only reason why Japan is still alive, I mean, they have a debt to GDP of over 230%. Well, what do? They have, financial repression. They keep interest rate at zero. Okay, well, that's what I call financial repression. But the Japanese are able to go and get US dollars, and so they manage. But if you're a US based investor, where are you going to go? Like, there's not a whole lot of places to go. You can buy some euro, but you're going to have to buy some gold at some point in time, because that's the asset that you cannot repress. So I'm very optimistic. No matter what the economy is going to do next year. Personally, I don't know. And frankly, as I said, makes no difference.
Pierre, as we wrap up, I'm going to put you on the spot now. What will do better in 2024, gold or copper?
I think they're going to be very similar. I mean, I could see gold up easily another 10% next year, like $2,200. And but I could see copper like 450, something like this, so maybe up like 10 to 20%. So I'm quite bullish on both metal. And just to come back for a second, to me, like the best deposits in the world, the best find are copper gold deposit, because those deposits, they last for 50 years. And you get the benefit of time and price for so long that you can't miss as a company. And that's why you have companies like Rio Tinto and BHP. How did they get that big? Because of these deposits. So if you can invest in a company that's got one of these, should be doing quite well. So back to your question, I'm indifferent. I think both copper and gold are going to do very well next year. Now, in terms of equities, I think the gold equities should do better than the copper equities simply because they're far more undervalued than the copper equities.
Well, that was a great discussion, Pierre, and I want to thank you for spending time with us today and sharing your insights. And I look forward to our next discussion.
Thank you, James. Always a pleasure, as I said. Thank you.
I hope you enjoyed that conversation with Pierre Lassonde. If you have any ideas or suggestions on who we should interview in the coming weeks, please drop us a line in the comments section below. We'd love to hear from you. One of the reasons we do these interviews is to help you prepare for your financial future. If you would like to speak with someone to assist you in preparing for your financial future, consider having a discussion with a Wealthion endorsed financial advisor at wealthion.com. After providing some basic information, Wealthion will put you in touch with a vetted advisor, and there's no obligation to work with any of these advisors. It's a free service that Wealthion offers to all of its viewers. Don't forget to subscribe to our channel, wealthion.com, and also hit that notification button to be kept up to date on future events. We have some amazing content coming up in the coming weeks that will help you prepare for your financial future. Once again, thank you for spending time with us today, and I look forward to seeing you again soon.